Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So last video we have started the new subject financial decision making 2. In the last video I have explained you about the CVP analysis, the break-even analysis, how the CVP analysis will be helpful to the management in profit planning. What are the different techniques applied in CVP? All these things I have already explained you in the last video. Hope my regular viewers have already watched. If you have not watched, I suggest you go to the playlist of my channel. Select the subject Financial Decision Making 2. Watch the first video, Introduction to CVP Analysis. Be thorough about the concept. Remember, only problems are not enough. You must have conceptual clarity, clear about the concept which are used in CVP analysis. Now in this video, I am going to explain you very important concepts which are used in CVP analysis. Apart from problems, in examination they may ask you the theory regarding what is contribution, how it is calculated, what is PV ratio, what is break-even point, what is margin of safety. So these are the concepts I am going to explain you in detail in this video. So if you want the perfect knowledge, complete command on this topic, watch the video till the end. Don't skip in between. Don't watch once, twice, thrice. If you watch, definitely you can get the complete command. So before starting the explanation of these concepts, take the screenshot of the points which I have written on the board, then I'll explain all the concepts in detail. Now, the first concept I'm going to explain you is about contribution. The contribution is the excess of sales over variable cost. In simple words, we can say sales minus variable cost is equal to contribution. So in this CVP analysis, marginal costing, we have to divide the total cost into two types of cost, variable cost and fixed cost, separate. So from sales, if we deduct variable cost, the sales minus variable cost is equal to contribution. So see here, this refers to excess of selling price over the variable cost. The excess of selling price over the variable cost, that is called contribution. It is also known as gross margin. Another term which is used for contribution is gross margin. Now the amount of profit can be ascertained by deducting the fixed cost from contribution. So how to calculate the profit? From contribution minus fixed cost, you will get profit. So simply you can remember like this. From sales, I am subtracting variable cost. So sales minus variable cost is equal to contribution. From contribution minus fixed cost, we will get the profit. Now, in other words, fixed cost plus contribution, fixed cost plus profit is equal to contribution. If you add up the profit and fixed cost, you will get the contribution. It can be expressed by the following formula. Now, the formula to calculate the contribution. Remember, contribution can be calculated per unit or total contribution. If you want contribution per unit, so this formula, contribution per unit is equal to selling price per unit minus variable cost per unit. Or if you want the total contribution, the total contribution is equal to total sales minus total variable cost. So simply you remember the formula C is equal to S minus V. C stands for contribution, S stands for sales, V stands for variable cost. The contribution is sales minus variable cost. Remember, whatever formula I am explaining right now, record it, make a note of it, because in the coming videos when I solve the problems, all these formulas will be used. Now again, one more formula is that contribution is equal to fixed cost plus profit, F plus P. C is equal to F plus P. The two formulas are there. C is equal to S minus V or C is equal to F plus P. Any formula you apply, you will get the same answer. That's it. This is all about contribution. The next very important concept of CVP analysis is PV ratio. Profit volume ratio. Simply we call it as PV ratio. This ratio is very important to measure the profitability of the business. To find the profitability of operations, normally we apply PV ratio. Higher the PV ratio, better, more is the profitability. The PV ratio is important for studying the profitability of operations of a business. Now, PV ratio establishes the relationship between contribution and sales. The PV ratio expresses the relationship between contribution and sales. Example, if 100 rupees are the sales and 40 rupees is the variable cost. So from sales 100 minus 40 rupees variable cost, you will get 60 rupees contribution. So if you want the percentage of contribution, contribution by sales into 100, 60 by 100 into 100, you will get 60%. In simple words, we can say the contribution is 60% of sales, right? So this PV ratio is simply the relationship between contribution and sales, or what is the percentage of contribution over sales, right? That's why this formula PV ratio is also known as CS ratio, contribution by sales ratio. The ratio can be shown in the form of percentage also. If you want percentage, multiply contribution by sales into 100, you will get it percentage. Example, 60 rupees contribution, 100 rupees sales. So if you substitute in the formula 60 by 100, you will get 0.6. If you multiply by 100, you will get 60%. So normally PV ratio will be expressed in the form of percentage. This ratio can also be known by comparing the change in profit and change in sales. Different methods are there for calculating the PV ratio. One method is we are comparing the contribution with sales. Another method of calculating the PV ratio is the change in profit by change in sales. When two period data is given, then we calculate the change in profit by change in sales. This ratio would remain constant at different levels of production. See here, whether we produce 10,000 units or 15,000 units or 20,000 units, whatever be the level of production, the PV ratio will remain constant, because the variable cost will change in proportion to sales. Whatever is the percentage change in sales, same rate variable cost is also changing. The variable cost changes according to the output. So percentage change in sales is equal to percentage change in variable cost. That's why the PV ratio will remain same at all the levels of output. Now, since variable costs are proportional to sales, in case of multi-product organization, PV ratio is vital importance for the management to find out which product is more profitable. See here, nowadays many businesses are engaged in multiple products. The business is not engaged in one product, different products they are making. In that case, the business wants to find out which product is more profitable. To find out which product is more profitable, we calculate the PV ratio of each product. Whichever product has more PV ratio, that product is more profitable. So PV ratio is very important for multi-product organization. So management tries to increase this ratio. Since the PV ratio shows the profitability, higher the ratio, better it is. So management will try to increase the PV ratio. So how to increase the PV ratio? Two methods are there. Decrease the variable cost, control the variable cost, reduce the variable cost, or increase the selling price. By increasing the selling price or by reducing the variable cost, our PV ratio will increase. Now, what are the different formulas for calculating the profit volume ratio? Different formulas are there. The first formula, C by S into 100. C stands for contribution, S stands for sales. In place of C, we can write down S minus V. See, a formula is there. C is equal to S minus V. So in place of C, I am writing S minus V by S into 100. Or if we are given F plus P, we can write C is equal to F plus P. So F plus P by S into 100. Fixed cost plus profit by sales into 100. Or sales minus variable cost by sales into 100. Whichever formula you apply, you will get the same answer. Depending on the information in the problem, we apply that formula. This is the formula for PV ratio. One more formula is there. PV ratio is equal to change in profit by change in sales into 100. This formula will be applied whenever we are given 2 period data, 2 years data. If 2 period data is given, we compare both the years sales and both the years profit. So change in profit by change in sales into 100. So these are the formulas for calculating PV ratio. I suggest you again, record, note it down all the formulas, because in the coming videos when we solve the problems, you should be able to remember, understand, recall the formulas of contribution, the formula of PV ratio. Next comes very important concept, that is break-even point. The break-even point is that point at which there is neither profit nor loss. No profit, no loss. Every business wants to earn the profit. At the same time, every business does not want to incur the loss. The business wants to find out at which level of activity my business will break even. Suppose I am making air coolers. Suppose if monthly 100 air coolers are made and sold, I will be no profit, no loss. If I make and sell below 100 air coolers, I will incur loss. If I make above 100 air coolers and sell, I will get the profit. At exactly 100 air coolers, no profit, no loss. So that 100 air coolers is called break-even point. That is break-even point. The point at which no profit, no loss. The break-even point can be defined as the point of sales level at which profit are zero and there is no loss. No profit, no loss. It is a point at which there is neither profit nor loss. Now break-even point is that point at which total cost is equal to total sales revenue. During a period of time, the total sales revenue are 10 lakh and the total cost incurred is also 10 lakh. The sales minus total cost will get the profit. 10 lakh minus 10 lakh, 0. So this 10 lakh rupees sales is the break-even point. So at the break-even point, profit being 0, contribution is equal to fixed cost. Since at break-even point there is no profit. When no profit means the fixed cost and contribution both are equal. If the actual volume of sales is higher than break-even, there will be profit. When the business will start earning profit if the sales are over break-even point. Example, I have given 100 air coolers, no profit, no loss, BEP. If I sell more than 100 air coolers, I will start getting the profit. Break-even point can be calculated by different formulas depending on the information given in the problem. So what are the formulas? Again, I suggest you record it, note it down, important formulas, because these formulas I am going to apply in the problems videos. Now, BEP in units. Remember, break-even point can be calculated either in units or in amount, rupees. So in value and units, both we can calculate. Example, at 100 air coolers per month, now my business will be at break-even point. Or my sales are 5 lakh rupees per month, then I'll attain break-even point. So this 5 lakh rupees is BEP in value, whereas 100 air coolers is BEP in units. So how to calculate units? Break-even point in units is equal to fixed cost divided by selling price per unit minus variable cost per unit. So denominator you can say selling price per unit minus variable cost per unit. And already we know selling price per unit minus variable cost per unit is nothing but contribution. Here I have written contribution per unit is selling price per unit minus variable cost per unit. So we can say the fixed cost divided by contribution per unit, that is BP in units. Now after calculating BP in units, we can easily find out BEP in rupees. So BEP in rupees is equal to whatever BEP in units you got multiply by selling price per unit. So BEP in units into selling price per unit will get BEP in rupees. One more formula is there. BEP in rupees is equal to fixed cost divided by PV ratio, profit volume ratio. This formula will be frequently used. If you want the BEP directly in rupees, not in units, directly in rupees, we can apply this formula. BEP in rupees, fixed cost by PV ratio. One more formula is there. BEP is equal to F into S divided by S minus V. F into S, fixed cost into sales divided by sales minus variable cost. You will get BEP in rupees. So these are the formulas for calculating break-even point. Now this break-even analysis can also be used to find out the units to be sold to earn a desired profit or sales to be conducted to earn a target profit. So every business wants to make profit planning. They will set a target. Next year we want to achieve a profit of 10 lakh rupees. So how many units we have to sell to earn the target profit of 10 lakh? Or we want to attain a target profit of 10 lakh. How much sales in value we have to conduct to attain the target profit of 10 lakh? So break-even analysis will help this situation by giving the formulas. These formulas are also very, very important. Note it down immediately. So here, break-even analysis also enables us to plan and production the sales to earn a desired profit. Number of units required to be sold to earn a desired profit. How many units we have to sell in order to earn a desired profit? The formula is fixed cost plus desired profit divided by SP per unit minus VC per unit, selling price per unit minus variable cost per unit. Or we can say like this, fixed cost plus desired profit divided by contribution per unit. Both mean same. So this formula will give you the number of units. Similarly, sales required to earn a desired profit. How much quantum of sales, how much rupees of sales to be conducted to earn a desired profit. The formula is fixed cost plus desired profit divided by PV ratio. Note it down, these formulas. That's all. So I have explained you about contribution, PV ratio and break-even point. Now the last topic, last concept I'm going to explain in this video is very important, that is margin of safety. Simply we call it as MOS, margin of safety. Very frequently in examination they will ask all these concepts. What is PV ratio, what is BEP, what is margin of safety, what is contribution. That's why I'm saying watch the video with full concentration. Now, margin of safety is an important concept in CVP analysis. Margin of safety is the excess of actual sales over break-even sales. The excess of actual sales over break-even sales, that is called margin of safety. Example, suppose our business break-even sales are 5 lakh rupees. At 5 lakh rupees of total sales, my business break-even, no profit, no loss. Suppose my actual sales are 8 lakh rupees. I will earn profit because my actual sales are more than BEP sales, right? So how much is the excess of actual sales over BEP sales? So 8 lakh minus 5 lakh. 8 lakh rupees is the actual sales, 5 lakh rupees is the break-even sales. So 8 lakh minus 5 lakh, 3 lakh rupees is called margin of safety. So the margin of safety may be expressed in units of output or sales revenue or a percentage of sales. Different methods are there for calculating the MOS. MOS can be calculated in units. MOS can be calculated in rupees, and MOS can be calculated as a percentage of sales revenue. Now, when percentage of sales revenue, it is called MOS ratio. So in the problem, sometimes it will ask you MOS, sometimes MOS ratio. So MOS ratio means the percentage of MOS on sales. Now, it's an important indicator of the strength or weakness of an enterprise. By seeing this MOS, we can judge what is the strength of the business, financial strength of the business, or weakness of the business. If a business is having huge or more large MOS, that means the business is financially strong. Suppose if the MOS is very small, then it shows the weakness of the business. Example, the break-even sales are 5 lakh rupees and the actual sales are 5,50,000 rupees. The business financial strength is very weak because only 50,000 rupees is MOS. Whereas if the actual sales are 6 lakh and the 8 lakhs rupees, actual sales are 8 lakh, whereas BP sales are 5 lakh, we can say financially strong. So this MOS will show the strength of the business. Now the large MOS indicates the soundness of business even with substantial firm. If the MOS is large, then what will happen? Even if there is a small decrease in sales, the business can be able to survive. Because the business is having huge MOS, even a small decline in sales, the business will not be much affected. But if the MOS is very small, then if there is a decrease in sales, definitely it will be a big jerk on the business. The business will be completely shaken. So MOS is the difference between the actual sales and the sales at BEP. Sales beyond BEP brings more profit. The sales beyond BEP will give more profit. The higher the MOS, more would be the profit. Now, the soundness of business is measured by the size of the MOS. By seeing the MOS, we can see whether the business is sound or not. Thus, MOS serves as an indicator of strength of the business. The following formulas can be used. So, what are the formulas to calculate the MOS? Again, very important here. 3 formulas I have given. First formula, MOS is equal to actual sales minus BEP sales. The actual sales minus break-even sales. This formula will give you MOS. One more formula is MOS is equal to profit by PV ratio. Any formula you apply, whether you apply first formula or second formula, you will get the same answer. Depending on the information given in the problem, you have to apply that formula. Sometimes it will ask you what is the MOS ratio. MOS ratio means percentage of MOS on sales. So the formula for MOS ratio is MOS by sales into 100. That's all. So this is the end of this video. I have explained you each and every point regarding contribution, PV ratio, break-even point and MOS. So if you are satisfied with my lecture, give a like to the video. Share my channel among your group, among your friend circle so that more students can watch the video and enhance the knowledge. Give your comments, subscribe if you have not yet subscribed, and buy the super thanks which is given below my video. Inshallah, we'll continue our discussion on this CVP analysis in the coming video.